Listen, while you were distracted by the shiny objects of the AI trade and the geopolitical drama in South America, the single most successful investor in human history just sent a signal that should chill you to your core. It is Wednesday, January 7th, 2026, and the Oracle of Omaha, Warren Buffett, has officially increased Berkshire Hathaway's cash hoard to a record-shattering $400 billion. Let that number sink in. $400 billion. That is more cash than the market cap of most of the companies in the S&P 500 combined. Buffett isn't just trimming a few positions here and there. He is villeting. The data is staring us in the face. The Shiller's SAP ratio, the ultimate measure of market valuation, is sitting at 39.42. Do you know the last time we saw a number that ugly? The dot-com bubble of 2000. That's it. That is the only comparison. We are currently 120% above the historical average for market valuations, and Buffett, who has been a net seller of stocks for 12 consecutive quarters, has finally seen enough. He is looking at the same thing I am looking at. A market that is fundamentally frothy and a consumer that is tapped out. If you are sitting there with 100% of your net worth in Magnificent 7 tech stocks, you are playing a game of musical chairs where the music has already stopped. You just haven't realized it yet. Buffett is choosing a risk-free 3.6% in U.S. Treasuries over the gamble of a 2026 equity market that is priced for perfection in an imperfect world. This is the ultimate shark warning. The exit door is getting smaller every single second, and when a $400 billion whale moves to the exits, everyone else gets crushed in the wake. Stay with me for the next 20 minutes. Because I am going to show you the leaked adjustments in his portfolio and the exact strategy I am using to build my own fortress of cash before the floor drops. Before I pull up the factor screens and show you the kill list of stocks that Buffett is dumping, I need to know, are you a passenger or are you a shark? Most people on YouTube are going to tell you everything is fine. They're going to tell you to buy the dip and trust the process. I don't trust processes. I trust data. If you want the cold, hard truth about the 2026 economy that the mainstream media is too afraid to broadcast, then you need to be part of this community. Smash that subscribe button right now. Kevin Strategic is your command center for the Great Reset of 2026. We look at the intersection of geopolitics, monetary policy, and your actual wallet. Hit the notification bell. Join the tank, because in this environment, if you aren't early to the exit, you're the one paying for everyone else's meal. Now, let's look at the $400 billion smoking gun and why Buffett just gutted his favorite stock. Look at this move. This is the part that should have you worried. For years, Buffett's Apple stake was the crown jewel of Berkshire Hathaway. At its peak, it was valued at close to $200 billion. But as we enter January 2026, that position has been slashed to just $60 billion. Think about that liquidation. He sold over $140 billion of the most successful company in the world. Why? Because Buffett is a master of the business cycle. He isn't raising cash because he thinks the world is ending tomorrow. He's raising cash because he knows we are in bubble times. He understands that when every Magnificent 7 AI stock is trading at a PE ratio above 30, there are zero attractive buying opportunities for a value investor. And here is the insider kicker. Buffett has officially retired as CEO of Berkshire at the start of this year, passing the torch to Greg Abel. He is handing his successor a $400 billion fortress of cash because he knows the 2026 adjustment period for shareholders is going to be brutal. He is leaving the game while he's on top and giving his team the optionality to buy the rubble when the panic hits. Buffett would rather earn a measly yield that barely beats inflation in Treasuries than risk his legacy on a tech sector that is priced for 100 years of growth in a single decade. He is choosing prudence over greed. If the Oracle is terrified of these prices, what makes you think you're smarter than him? Now let's look at the macro landscape that is driving this flight to safety. 2026 is officially being called the year of instability. We are trapped in a cash-shaped economy that is tearing at the seams. On the top half of the K, you have the high-income earners who are feeling great because their portfolios have been inflated by the AI boom. But on the bottom half, you have 50% of the country that is absolutely suffocating. Low-income households are being crushed by sticky inflation that refuses to drop below 3%. We are seeing a deceleration in the labor market that is terrifying. We only need to add 30,000 to 50,000 jobs a month to keep unemployment steady now, because the labor force is actually shrinking due to deportations and an aging population. This is growth without jobs. And then you have the tariffs. Protectionism has returned with a vengeance, lifting retail prices by nearly 5 percentage points. That is a $500 billion tax on the American consumer. Business planning has become impossible because of this uncertainty. The instability is the signal. When the middle class can no longer afford to buy the products that the tech giants are selling, the earnings multiples collapse. Buffett sees the consumer breaking. He sees the K splitting, and he is getting out of the way before the gravity of reality takes over. Skate to where the puck is going. Right now, the puck is headed toward a massive CapEx reality check. Wall Street is projecting that AI companies will invest more than $500 billion in 2026. Hyperscalers like Microsoft, Google, and Amazon are spending like drunken sailors on data centers and chips. But here is the shark question. Where is the revenue? To justify this $500 billion spend, AI revenues need to grow from $20 billion today to $2 twirl in Mate Pine 23. That is a 100-fold gap. If that revenue doesn't materialize and fast the AI supercycle turns into a debt trap, we are seeing circular financing, where companies are essentially investing in each other to keep the spending high. It looks a lot like the telecom bubble of 1999. Buffett has stayed away from this infrastructure trade because he knows that being an early adopter doesn't guarantee investment returns. Remember the railroads? They revolutionized society, but the investors who built them went bankrupt. The AI giants now comprise 35% of the S&P 500. That is a higher concentration than the dot-com peak. We are in a single theme market, and when that theme gets questioned, the $400 billion man will be the only one with the cash to buy the survivors. Here is the monetary shock that nobody is talking about. The Fed is facing a leadership reset in 2026 that will be the most significant in 40 years. The dual mandate of stable prices and maximum employment is being tested by 3% sticky inflation. The 10-year Treasury yield is expected to average 4% all year. That means the risk-free rate is high enough to act as a vacuum, sucking capital out of risky stocks and into safe bonds. If the Fed can't get inflation back to 2% because of tariff pressures and high government spending, they will be forced to keep rates higher for longer. Buffett understands that in a higher-for-longer world, the valuations of high-growth tech stocks must come down. It's basic math. If you can get 4% doing nothing, why would you pay 40 times earnings for a speculative AI play? The Fed is no longer your friend. They are the probation officer of the economy, and they are here to collect. Buffett is sitting on the sidelines, collecting his 3.6% in Treasuries and waiting for the Fed to break the market. Let's talk about the biggest wealth killer of 2026, real estate. The housing market is officially in a recession. Sales are down 20% since before COVID, and home building employment is flatlining. I have a simple rule: your mortgage, insurance, and taxes should be no more than 1/3 of your after-tax income. But today, millions of American households are spending 40% or 50% just to keep a roof over their heads. They are one house poor. They are one paycheck away from disaster. With mortgage rates remaining stubbornly high, the American dream has become a financial anchor. Buffett knows that a stressed consumer can't drive the economy. He isn't buying residential real estate. He's buying optionality. If you are stretching to buy a home in 2026, you are trapping your capital in an asset that is losing liquidity every day. Don't be a victim of the mortgage trap. Stay liquid. Stay strategic. So, what do I do with my money? I don't just guess. I use a factor screen. I look for 4 things: return on assets, ROE. Is the company actually making money with the capital they have? Asset turnover, how productive are their assets? Accruals, I look at the future liabilities. I want to see a clean balance sheet. Leverage, I want 0 debt. Debt is the cancer of the balance sheet in a high-rate environment. I also follow the 5% rule. I never put more than 5% of my weighting into any one name. Diversification is the only free lunch you get. While the crowd is 35% concentrated in tech, the shark is diversified across energy, infrastructure, and high-quality dividend payers. I am looking for jewels, the companies that have the pricing power to survive inflation. This is the bottom line. Warren Buffett is handing over the keys to Berkshire Hathaway with a $400 billion final warning. He is telling you that the risk-reward ratio in this market is broken. He's telling you that the AI hype has outrun the reality of earnings. Do not be the last one holding the bag. Do not assume that because the market went up yesterday, it will go up today. The Schiller SAPEEP at 39 is a red alert. I am rebalancing my portfolio as we speak. I am moving into cash. I am moving into dividends, and I am moving into dividends, and I am moving into strategic assets like Canada's energy grid. Hit the like button if you want to stay ahead of the curve. Comment below. I am a shark, so I know who is ready to protect their wealth in 2026. I'll see you at the closing bell. Don't get slaughtered out there. Get rich.